Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. And as part of the Nasdaq Fund Network's College Savings Month, we are finishing out the month with JP Morgan Asset Management's Executive Director, Mike Conrath. Mike, it's great to have you on Trade Talks. Welcome to the show.
Thanks, Jill. Happy to be here.
I know JP Morgan Asset Management has published a series of articles, COVID in College, that highlight the effects COVID has had on planning, applying, and attending college. Can you share with us some of your most interesting findings, and given COVID, how clients should be thinking about funding college today?
Sure. Well, for starters, Jill, I think of this through the eyes of a parent. And as a parent with 3 kids myself, this is really the part that hits closest to home, because there's 2 things at play here. One is costs continue to climb, and 2, financial aid is actually going down. So there's this growing gap that families are facing. And just in terms of the costs, looking back historically over the past 3.5 decades, costs have gone up 800% cumulatively. So that breaks down to roughly 6% a year. But what are we seeing today? Many schools today, it's not uncommon, unfortunately. Again, looking at this through the eyes of a parent, for a school to cost upwards of $80,000 plus per year. And many families sometimes will say, hey, you know what? Costs have to cool off at some point. Or you know what, Mike, they only went up 3% this past year. This can't continue. Well, as a parent, I say, sure, hope so. But as we know, hope is not a strategy, and college planning is no exception to that. So let's say costs do go up only 3-4% a year. If you're already starting with a baseline, Jill, of $80,000 a year, 3 to 4% on top of $80,000 a year times 4, maybe more years, is still a really big number. So again, it's really important to understand the costs. And in terms of COVID, frankly, colleges took tremendous revenue hits over the past 1.5 years due to COVID. So enrollment is down, fundraising is down, and government support is nowhere where it used to be. So tuition, if you think about it, is really one of the key levers that colleges have left to pull to cover their own revenue shortfalls. So you can't really bank on costs plummeting or the government bailing you out of this or paying for all of your costs. And as I said before, aid simply has not kept pace with tuition inflation. And you know what's interesting, many families are getting in the habit, or the new norm is to appeal your initial aid award. And why, I would advise families to tackle that approach if they think it could up their game from an aid perspective. The reality is what we've seen the past year is, look, 90% of colleges said they expect families to appeal those aid awards, but 78% of those same colleges said they're not going to lower prices as a result of those appeals. So again, you have this revenue pinch that the colleges are feeling, which translates for families into a financial aid crunch.
Mike, how can families best prepare for financing college then? What are some of the pitfalls one should avoid?
Yeah, it's a great question, Jill. And in fact, the way I've seen things over the past few years is that families really fall short for 2 key reasons, putting costs aside just for a minute here. Number one is they have very unrealistic expectations about financial aid, and I'll talk more about that in a second. And 2, they simply don't invest. So let me come back to that one. So let's talk about unrealistic aid expectations. And again, as a parent, I've been guilty of this at some point or another. I call this the myth of the free ride. And look, at one point, many of us as parents thought we were raising you to the next star athlete, the next concert pianist, or just that supreme academic scholar, okay? Well, here's the reality check around that, Jill. Over the past year, the percentage of students that actually received a free ride was 0.3%. So put another way, Jill, that's 3 out of 1,000 students actually received enough money to cover all of their tuition, room and board, all of their costs, 3 out of 1,000. So again, as a parent, you have to take off those rose-colored glasses and have a realistic aid expectation. So, and in terms of dollars and cents, typical family past year actually paid 15% more out of pocket than they expected. So that really has hurt families. So that's number one. Number 2, the other pitfall we're seeing is quite simply families are not investing. So you might be scratching your head saying, well, sure they are. Most families are saving. And yes, they are saving, but they're not investing. And here's what I mean by that. 49% of families, Jill, are actually sitting in cash. And if you think about what a typical savings account generally pays today, you're in the ballpark of the goose egg, 0%. So 0% on a savings account compounded over 18 years is still pretty much 0%. So your money needs to be invested in order for it to grow over the long term. So how can we manage around this? Well, one of the best ways to prepare, quite simply, is to have a plan. And it doesn't have to be complicated, but what I've seen work for many families is have a simple plan that focuses on three key things. Number one is understanding the cost, and we talked about that. Two, know what to expect from aid, and we covered that as well. And three, again, get invested. And this is where something like a 529 plan might be beneficial to you, your student, your entire family, because not only does it offer powerful advantages from an income tax perspective, but it also offers some very powerful state and gift tax planning advantages in addition to flexibility. And I've heard some families say that they're concerned about what may lie ahead in terms of the tax environment, or they might be thinking that they're potentially entering a rising tax environment. Well, what I say is 529s are very powerful today. They could become potentially that much more powerful tomorrow if the tax environment evolves.
So, Mike, what are some of the most important questions parents and caregivers should be asking their advisors when saving for college?
Well, I think you hit the nail on the head, Jill. First of all, is seek out the advice of a financial professional. That advice that person gives you will be unbiased, and it could be invaluable to making sure that you do have a plan. And I would say there's two questions that I would ask, Jill. One is, what is my number? So in other words, what should I expect to pay? And more importantly, how much do I actually need to invest today to get there? Whether it's looking at a public or a private college, or I'm looking to fund all or even half the cost, how much do I actually need to invest today? And it doesn't have to be all or nothing. It doesn't have to be just a lump sum. You can invest monthly amounts as well. And small contributions do add up to meaningful dollars over time. But it's important to understand, what is my number? And that number will be different for every single one of us out there as parents. So that's the first question. The second question is, back to 529 plans, how can a 529 plan personally help me? And I know there's a lot of options, which is great, but which one do I actually choose? So it's important to recognize that not all 529 plans are equal. They generally offer the same tax advantages, but in terms of the actual solutions that they offer, they could vary in terms of, well, state tax savings is one thing to consider. See if your home state does offer some state tax incentive. But outside of that, they'll have different investment managers, different fees, expenses, and different performance results over time. So along these lines, to help families navigate that selection process, JP Morgan actually just released a paper. So our multi-asset solutions team authored a paper, which you could go online. You can go to JP Morgan's website or NY529 Advisor or jpmorganfunds.com. It's called Evaluating 529 Plans. And this covers a range of factors to consider. So that could include the asset class diversification, the glide path design, the portfolio construction, importantly, especially as we're seeing market volatility, tactical asset allocation. So in other words, does your 529 manager tactically adjust those portfolios as market conditions evolve? So whether market conditions evolve over the short term, you still want to be focused on the long term, but you want to take advantage of opportunities or de-risk as well where it makes sense. And that's where outsourcing that to a manager who has that flexibility can potentially reap greater benefits for you and your family down the road. So whether you're considering JP Morgan or any other 529 plan out there, it's important to look under the hood, or if you're currently invested in 529s, understand what you own. And again, most importantly, work with your financial professional and make sure that that 529 manager is aligned with your long-term goals and that you do have that plan to get there.
All right, Mike, amazing advice. Thanks so much for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.